Hi, Ryan. How you doing? Hi, Bernie. Looks like both of you are connecting to the audio section. Hi, Christy. How you doing? Can you hear me, Christy? Okay, you're muted right now. Okay. You need to unmute if you want to talk
Got
with
it.
me.
Unmuted.
There you go. Now you're unmuted. Excellent.
Now I'm unmuted. Yep.
Hi, Ryan. How you doing? You need to unmute.
Oh, hi. Hi.
There you go. Good to hear. Good to hear from you. Do you want to show your face, Ryan?
No, my camera has a problem at the moment.
Okay. And hi,
Yeah.
Bernie. How you doing? Okay. All right. There's Bernie. Good to. All right. Okay. What we're going to do here is I went over chapter one already last week, and that lecture is online right now. But I'm going to go through one again in a much more brief, truncated fashion, and then let's get into chapter two. I'd like to keep us about at least a chapter ahead of the curriculum, and still giving you sufficient time to keep up. Okay. So let me start by sharing a screen. And we want chapter one, huh? Okay. Let me set this up so I can see it. Okay. Introduction to accounting. And those of you, Christy, did you see the lecture already on chapter one
Yes, I
online?
did. Yes.
Okay.
Yes, I did. I already
Okay.
reviewed it. Yeah.
Okay, so bear with me as I go through it a little again, and then we'll jump into chapter two. The purpose of accounting, it is the language of business. It provides it information about the financial status of the company. Owners use this. Owners use the information. So do managers, creditors, and government agencies. The ownership of the business certainly wants to know if they're making money. Managers may have more detailed needs for information in order to do their jobs properly. Creditors are people who lend money to us. That's what a creditor is, a lender. And no one's going to let you borrow money unless you have audited financial statements. And of course, the United States government is interested in your position to pay taxes. And the accounting process, we're gathering information and we're going to work with it and eventually report it. These steps here, I'll let you look at these on your own. These steps here, they like to put these on the test in different ways. They might ask you what they mean by classifying. So just understand that you're going to analyze every day. Again, I always use the example of the electric bill comes in the mail. You open it up and you say, "Whoa, it's the electric bill, $100." That's your analysis. Then you go into your system, QuickBooks or whatever you're using, and you enter that information. And when you're entering it, you're putting it into the right classification. This would be a liability and an expense probably. And then at month end, you summarize, you report, and then you're going to maybe interpret the information in the form of the 10K report. I used to have to write a letter every month. What happened? Profit this month fell short of expectations due to this. And you'd have an interpreting letter accompanying the financial statements. GAAP and FASB, those are the two acronyms we want to know, huh? Generally accepted accounting principles. These are the rules of accounting. Tell you how to do things according to GAAP. FASB, Financial Accounting Standards Board. They're the ones who make up the rules. They make up the rules of GAAP. Three types of business: sole proprietorship, partnership, corporation. what a sole proprietorship has in common with a partnership is the owners assume risk personally. If you open up a business in a small business with just a little bit of your money, and you end up owing $1 million for some reason, you're responsible personally. They can come after you and take your car and all those dreaded things that could happen when you go too deep into debt. Okay. Advantage of a sole proprietorship, you do everything yourself. You make all the decisions. A partnership has the same severe personal liability. The partners share risks. One problem with a partnership is you may not agree on how to do things all of a sudden. If one partner quits, that's the end of the partnership. Third structure, corporations. These are the big companies, Coca-Cola, Microsoft, General Motors. You and I can go in and we can buy stock and we become owners. You go in and you buy 100 shares of General Motors. You are a part owner of General Motors, but you're protected by the corporate shield. If the corporation went out of business and they were horribly in debt, you personally are not responsible. You just probably going to lose your investment. And different businesses by activities. We're going to start off as we get into chapter 2 in a moment with a service business. A student who started a business delivering things around campus. I like to say delivering pizzas. A service business, not involved in a physical product. What are we talking about? We're talking about travel agencies, computer consultants, doctors, lawyers, architects, CPAs. Business that buys and sell a product, that's a merchandising business, huh? That's our department stores, our pharmacies, grocery stores. As we go later into the course, we're going to be like Nordstrom's. We're going to be buying and selling something. We're going to be buying garments and selling them hopefully at a higher price with all the problems inherent in that cycle. And then a manufacturing business. This is accounting 240. You're actually building a product. Think of it this way. Service business is 110 for the most part. Merchandising is accounting 230 and then accounting 240. Career opportunities. I'm going to just skip this just to talk about real quick. Accounting clerks, that's your basic starting position. Bookkeepers, usually you require a certificate and a certain amount of expertise. I've never heard of a para accountant, so I'm going to skip that. It's got to be like a paralegal. And then you have the accountants. These are the people who actually design the system. They're doing the interpreting. I think I told the class when I was in college many years ago, computers were just coming out. Imagine a world without PCs. But you had these big mainframe computers. And the fear was, oh my goodness, we don't need accountants anymore. We got computers. Well, it turned out to be just the opposite, because the more data you generate, the more there is to mine, the more there is to work with. So computers make the more and more computer sophistication makes the accounting role all the more important. And then you have public accounting. That's what you work for a company like Nordstrom's or something. Just let me start again. I'm sorry, I didn't say that right. Public accounting. Public accounting. Those are your CPAs. Those are the independent auditors coming in to attest to your financial statements. You could be a CPA, and now they have something called the Certified Fraud Examiner. And I bet there's a lot of opportunities in that field, sad to say. Then you have private accounting. That's you go to work for a local business on State Street. You go to work in the accounting department, or you're a salesman for a business. That's private, okay? And controller is a high-level accounting officer of a company like that. And that's what I was mostly for most of my working life. I was a controller of different levels. And then your government nonprofit. And there are tons of nonprofits in Santa Barbara, a lot of job opportunities there. And I'm not going to go into the job descriptions. We just kind of did that. So with your forbearance, I'm going to leave chapter 1. If you want to see more in detail, you can always go to the lecture that is already online and available to you, okay? So let me see if I can get us into chapter 2 here. And I'll ask you to hold on here. Chapter 2. Let's see, share screen. Hold on, I want to get the right chapter here. All right. Can you see the PowerPoint, Christy? I'll use you just to double check. Not yet?
I can, yes, and that's correct.
Okay,
Yep, I got it, and that's correct.
okay. Because as I might have explained in a prior chapter, I've made the mistake of not double checking with the class, and I spend an hour talking and pointing at things and highlighting. At the end of the class, they said, all we saw was your bald head for an hour. And that's not good. We want to avoid that, okay? All right, here we go. Analyzing accounting transactions. We learned that the accounting equation is assets equals liabilities plus equity. Assets equals liability plus equity. And one of the accounting principles is that the business entity concept. It simply means the business entity concept means that a business can be broken down into a finite period of time and analyzed, typically monthly. Every month, companies go through what they call the closing process. That's the business entity concept. So we have assets equals liabilities plus equity. What are assets? Anything of value we own, right? Remember, cash, merchandise, furniture, fixtures, etc. All assets, all things that are going to bring us value in the future by utilizing the assets. You utilize the assets to create profits that furthermore increase your assets. So you want that cycle growing all the time. Accounts receivable, let's understand that. That's one of our assets. That's the amount of money owed to the business at a particular point in time. The month ends, say, on June 30th, tomorrow, I guess. The month ends tomorrow, and you see $1 million next to accounts receivable. That simply means that's how much all of their customers owe to the business at that time. Most business is done on credit basis. You know, you're not driving around all the time with cash in your pocket making these big purchases. You have credit terms with your business associates. When you see a transaction and you see the words on account, expand that. Say to yourself, on account of no money. And the reason I say that is whenever you see that in a transaction, you know that there was no cash involved in the transaction. The cash will come later in the cycle. Okay, assets are good things to own. Liabilities are offsets to assets. Liability is an IOU. It is a payable. It's what we owe at a particular point, and it's called accounts payable. Accounts payable is what you owe to your vendors at a particular time. So what you call $1 million in accounts receivable to the people you owe the money to, that's their accounts payable. One man's accounts receivable is another woman's accounts payable, okay? Referred to as making a purchase on account. Remember, on account of no money. And then they're warning you, try to avoid this very common mistake when you get started. Don't confuse accounts receivable and accounts payable. Ask yourself, are we waiting to receive money for something we sold in the past? Or are we waiting to pay for something we purchased in the past? Accounts payable, accounts receivable. Notes payable is simply a borrowing instrument. When you see notes payable, it represents the principal of an amount that we borrowed. Accounts payable is your normal business vendors, the people you normally do business with, your suppliers, the electric company, the utilities, insurance people. That's all accounts payable. But if you borrow money, that becomes a note payable. And the reason you have it in a separate account called notes payable is that notes payable is a formal contract with things like the interest rate specified, the terms of payment, the length of the note, etc. And if you don't pay, there are severe penalties on top of that right away. Accounts payable, there's no written contract with that. You're pretty much running on faith. You checked out your vendor and they've checked you out, and you're willing to take some risk in giving each other credit. Notes payable also have a little bit of hierarchy advantage. If a business starts to fail and then they're going out of business, if you hold a note, you will get paid before the accounts payable people. So you might have a situation where somebody owes you money and they're 60 days late, and you're calling them and they say, look, we're in trouble, but how about we turn this into a note and I'll pay you back in a year when I get back on my feet. You might go for that because you'll collect some interest during the note period. And if there was a bankruptcy of this company, you'd get a better shot at their assets. Assets equals liabilities plus equity, huh? Assets equals liability plus equity. Equity is the net worth of the company. It's simply the amount by which the assets are more than the debts. If you have assets that exceed the debts, you have net worth. If you have liabilities that exceed the assets, technically you're out of business. On paper, you are anyway. Of course, you can keep going and try to bounce back. But the owner's equity is also called capital. Equity and capital are interchangeable terms, so you're going to see them used back and forth. Assets and the cost of products we buy. All right, I'm going to skip that. Now let's look at some transactions, okay? The accounting equation, here it is again. Assets equals liabilities plus equity. The left side shows the assets and the right side of the equal sign shows the liabilities and owner's equity, okay? Now, why are we emphasizing that, huh? If a business had total assets of 60,400 and their debts, their liabilities were only 5,400, what is the owner's equity? In other words, what's the owner's capital? What is the net worth of this business on paper? Well, 60,000 in assets minus 5,400 in liabilities is going to equal the 55,000. So on paper, this company has a net worth, total owner's equity or owner's capital of 55,000. And guess what? The accounting equation must always be in balance. It can never go out of balance. I don't think in the year 2021 and going forward that should ever be a problem, because no computerized accounting system will allow you to post an entry that is out of balance. That used to be a problem in the old pencil and paper days, but I don't think you're going to have that problem anymore. But be aware, the accounting equation must always remain in balance. So let's look at some transactions. We're going to look at a few transactions now for the rest of this chapter. And we're going to use words like plus, minus, increase, decrease, up, down, which is not accounting language, but we want to get us familiar with maintaining the accounting equation and how these transactions affect it. So let's get started here. What is a business transaction? It's an economic event that affected the business. Something that affects the financial statements is how I would say it. And it's typically with an exchange of an outside entity. You're paying people, you're paying your suppliers, you're collecting money from your customers, you're buying insurance, you're paying for the insurance. Those are all transactions. You get a bill in the mail, that's a transaction. All business transactions affect the accounting equation through specific accounts. And if you look in your textbook and you open up the back page, you'll see what's called the chart of accounts. And that's what we mean by the specific accounts. And eventually we're going to build up into that, what you see in those last 2 pages. An account. It's a separate record used to summarize the change in each asset, liability, and owner's equity of a business. Well, you set up a business and you can have as many accounts as you want. You can have one if you want to throw everything into one pot. But typically you say, okay, cash. Oh yeah, I want to make sure I understand what's going on with cash. So you set up that account. Think of it as a folder where you're going to put the information. You're going to have one for accounts receivable. You're going to have them for all different types of things. So let's start to look at a few transactions. And there are 3 things that they want us to kind of get in the habit of doing here. And hopefully this will be second nature in a week or so. 3 questions. What happened? Make sure you understand what just happened. Well, we got a bill from a supplier. The guy who provides us with the garments that we sell, he sent us an invoice. Okay, well, we got an invoice that we have to pay. That is the transaction. That's what happened. What accounts are affected? Well, let's see. We have to identify the accounts and classify them as assets, liabilities, or equity. Well, in my brief example here, we got a bill for some goods we bought. So it looks like we're gonna have to deal with an asset called cash. And we're also probably gonna have to have another asset, maybe for the supplies we purchased. And then think in terms of how it affects the equation. Determine what has increased and decreased. Keeping in mind the accounting equation must remain in balance. So let's look at a few transactions here. All right, welcome to the first transaction of accounting 110, course number 8007. Big moment, huh? Somebody started a business. Mitchell Williams started this delivery business. He's a student, what we're going to learn. And he took $5,000 of his own money and he put it into a new company bank account. And he gave his company the name Mitchell Williams Capital. Okay. So what happened here? Well, just like I said, he started the business with some money. Well, what are the accounts that are going to be affected? Well, cash is certainly going to be affected because now we have a business with cash, and that's the only activity he had. So that also has to be the capital. So we're going to look at this and we're going to say classify as assets or equity. And I think we can skip right to the chase here. So take a look at your accounting transaction. We're going to be building on this now for the rest of the class. Assets are now $5,000 equals liabilities plus equity. We don't have any liabilities yet. So very simply, that's his business right now. It's his cash, and that represents the equity in the business. So let's see here. Mitch went out and he bought some equipment. He went out and he bought some motor scooters to have his guys deliver pizzas around campus. Okay, so what happened? He bought equipment. Well, I'm sure we want to have equipment, delivery equipment, in a separate account, a separate folder. So the accounts that are going to be affected are cash and delivery equipment. Notice it said he bought delivery equipment for $2,000 cash. If that said on account, that would not be cash. That would become accounts payable to be paid later, okay? So let's see what we have here. We have cash and we have delivery equipment. They're both assets. So what we did here was we exchanged one asset for another. We had $5,000 in the bank and we used part of that to buy delivery equipment for $2,000. So our delivery equipment now has a $2,000 balance and our cash has been reduced to $3,000. We're still in balance. All right. C. Now he bought it on account of nobody had money. So there's no cash involved in this transaction. That means that the payment's going to be made later. But for now, what did we do? We bought equipment and we bought it on account. And they're just telling us in the future, we're going to make the payments over 3 months. So let's see, what did we buy? We bought delivery equipment. So that has to go up. And now we have accounts payable. We owe it. Accounts payable also has to go up. So we have 2 increases here. Let's take a look at the transaction. They're going through this thought process here. Take a look here. If this thing starts to get too small, please let me know and I can zoom in on it, okay, please? So look at the assets. We now have an additional piece of equipment, $3,800, but we didn't pay cash for it, so we're not going to reduce cash. We're going to increase accounts payable. So at this point in time, this company now has a debt of $1,800, and the capital is still $5,000. What you're going to learn shortly is that the only thing that affects capital would be sales and expenses for the most part, and we'll get there shortly. Okay, he paid down a loan. They're calling it a loan. It was accounts payable. That's fine. Little disconnect there, but that's okay. So Mitchell now paid 1/3 of that $1,800. That's what happened. We understand that. The boss came out and said, cut a check, pay 1/3 of that $1,800. That's what happened. What accounts are going to be affected? Cash and accounts payable. And those are, one is an asset. Cash is an asset. Accounts payable is a liability. Which accounts have increased or decreased? The cash decreased because we're making a payment, and so did the accounts payable. The accounts payable decreased because we no longer owe them $1,800. We paid $600, so that debt is down to $1,200. And take a peek at it again. What do we have here? We have a decrease in cash. We had $3,000, now we're down to $2,400. Good gosh, we're running out of money. And we paid down 1/3 of our debt. So the payables have gone down to $1,200. 6,200 equals 6,200. We're still in balance, and the equity is still $5,000. Here we go. Now revenues. Revenue. Another word for revenue could be sales. It's any generation of income, really. It's a rather generic term. It could be sales, it could be rental income, it could be different things. And that's what they're showing you over here. It could be delivery fees, consulting fees, just regular sales. So sales revenues are recognized when you make the sale. It has nothing to do with when the cash was paid, okay? We're on what's called an accrual system of accounting, which is GAAP. We recognize revenues when the sale is made, and the offset to those would be expenses. We recognize them when they're incurred and not necessarily following the cash. Expenses, they represent the decrease in our assets as a result of trying to make some money, okay? Rent expense, salaries expense, supplies expense, tax expense, insurance expense, wages expense. There's a whole ton of them. Travel expense, you can go on forever. The accounting period concept is the concept that we can always make a business understandable by breaking it out into a year. The business entity concept we looked at earlier is a similar presentation, but that just says that the business itself is an entity that can be analyzed. Here we're saying that entity can be broken out into a particular period of time. You can do it for a month, a quarter, a year. You could do it every day if you were so inclined. And any accounting period of 12 months is called a fiscal year. So know that term, a fiscal year. A fiscal year doesn't have anything to do necessarily with a calendar year. Different companies have their fiscal year start at different times. You might be interested, General Mills, which is a cereal maker, their fiscal year begins, I believe, in like April, which is the start of the harvest season, and closes the following following March, I guess. So businesses sometimes have this strategically set up to choose their fiscal year. Big stores like Nordstrom's, they love to close at the end of January or February. They like to strike right after they've had that big December sales month and get those statements out a couple months later. Net income versus net loss. I don't think we need to spend too much time on this, do we? If you have more sales than expense, you made money. If you have more expenses than sales, you lost money. Who knew? Let's talk about something that's a little bit tricky here. Withdrawals. This is an impact of the owner taking cash or other assets from the business for personal use. And when that happens, that reduces the owner's equity and his assets. Withdrawal can be called drawing as well. And obviously, we're talking small companies here. The boss might have an ATM card, and he or she went out to lunch with a potential customer and paid with the card. And you got the bill in the mail. Let me make that clear. I didn't say that clearly at all. Let me start again. The boss came to you and said, give me a check for $100, please. You said to your boss, what's that for, boss? And she says, I'm taking my family out to dinner tonight. Well, that's clearly not a business transaction. It's a reduction in the business's value, though. What happened there was that owner, by taking that money out, reduced the asset cash, and it also reduced the capital through an account called withdrawing. So here they're showing you the accounting equation as it looks after those few entries, okay? Let's see what we got here. Delivery revenues. Mitch received $2,100 for deliveries. He delivered $2,100 worth of pizza, and he got paid for it, okay? He got paid. So what are we doing here? The cash obviously is going to increase, and he can now recognize a sale and record his revenue. He calls his revenue delivery fees, all right? So let's see. Cash went up by $2,100. So did delivery fees, nothing to do with liabilities. And now we've added to the equation. What went up? Cash went up. That was a nice hit, $2,100. His sales went up. His sales went up. And notice that revenues and expenses and drawing are all under the heading of owner's equity. As we learn this a little more in the next week or so, you'll start to understand that a sale will increase the owner's equity, expenses will reduce it. And that's why you have these plus and minus signs here. Cash plus delivery equipment equals accounts payable plus capital. That's your accounting equation. Cash equals liabilities plus all of this equity activity. He paid the rent. For some reason, he has to have an office, and he paid the rent. That's what happened. Well, what happened here in terms of the movements? Cash decreased and rent increased. That's an expense. So let's see. Cash went down by 1,000, and we know the equity went down because this is an expense. So we're going to record it as rent expense. And here we go. What went up? Expenses went up. What went down? Cash went down. We're still in balance, $7,300. So far, we have $2,100 in sales or revenues, 1,000 in expenses. So if the month ended today, this business would show a profit of $1,100. Okay. He had to pay the phone bill. As soon as you see the word paid, that's cash. Paid equals cash. Okay. So we know cash went down $100, and so did the equity through phone expense. And here we go. What went up? Phone expense went up 100. Cash went down. Cash went down. We're still in balance. 7,200 in assets equals the 1,200 in liabilities plus the 6 plus the revenue minus the expenses. Now here he made a whole bunch of deliveries on account, and nobody had money. So Mitch, maybe he made a big delivery to somebody for $2,400. And the deal is, this guy's going to pay him maybe in 30 days. So Mitch delivered everything. And when he delivered everything, he handed the guy the invoice. And the gentleman probably signed for the goods as well. So what happened? We delivered delivery services in the amount of $2,400, but we're not going to get paid until later. This is classic accounts receivable. Accounts receivable went up, not cash. Accounts receivable went up, and so did the owner's equity via delivery fees. And here we go again. We had a big sale. Man, we sold a bunch of pizza. Maybe he catered something. Accounts receivable went up, that asset went up, and the revenue went up. So right now he's looking at a nice profit, 4,500 minus 11, that's $3,400. We're still in balance. He bought supplies. When he bought supplies, this is not an expense. We're going to call it an asset. There's no such thing as supplies expense until you use the supplies. This is what you're going to learn is called a prepaid account, prepaid supplies. So he bought the supplies and they're going to be used for the next several months. So that means at the time he purchased the supplies, it's an asset. So we're going to increase an asset called supplies and credit. I don't want to say credit yet, but we're going to increase assets by $80 and decrease cash by 80. So it's really a swap of one asset for another. We now have $80 worth of supplies for which we paid $80 in cash. In balance all the time. Supplies is a prepaid expense account since the supplies are going to be charged off to expenses when they're consumed. You don't have to worry about that for a chapter or two. That gets a little bit tricky when we get to chapter 4, I believe. Cash receipts. Now, remember, he had that night, we got $2,400 sitting in accounts receivable, and it looks like some of the customers paid. So what happened? We got a check in the mail from one of our customers. That's what happened. So what we're going to do is we're going to increase one asset, cash. Cash, our favorite asset, is now increased by $1,900, and accounts receivable, another asset, is decreased, and that keeps us in balance. Let's look at that together. What happened here? We sold something for $2,400. We did that on the 5th of the month, just picking a date, and now it's 10 days later. We get a check in the mail for $1,900. So our cash went up, but the customers no longer owe us $2,400. They only owe us $500. So that was just an exchange of assets. Revenue is recognized when it's earned, not when the cash is received. The revenue was that $2,400. Okay. Can't see this purchase. Oh, okay. All right. We purchased an asset on account, but we're making a partial payment. So now we're going to have a transaction with three, 1, 2, 3 accounts. Our first one. What happened? Mitch bought a scooter. Oh yeah, how's he paying for it? Well, the scooter cost $1,000 and he has to pay $300 now and then agree to pay the remaining $700 later. Okay, so that sounds a little more complicated. What accounts are involved? Well, we bought equipment for $1,000, so we know that's going to go up by 1,000. We paid cash, so that's going to go down, and we took on a liability. So cash went down by 300. We bought $1,000 worth of equipment, and the difference goes to accounts payable. So let's see what we have here. Delivery equipment, $1,000 increase. We paid $300 down payment. That means we owe $700. Okay. And again, the numbers have changed a little bit, but we're still in balance. 10,300 asset equals all of this to the right. If you have any questions or you think I'm going too fast with my New Jersey patter, let me know. Because if you want me to go fast, I can get the whole course done in about an hour, okay? All right. Payment for premiums. Here, we bought an insurance policy that's going to last us 7 months. This is another, what's called a prepaid asset. Yeah, we paid for insurance expense, but that policy does not go into effect for the next, until the next month. In other words, it's going to go through at about $70 a month. So what happened here? We purchased insurance. That's an asset. That's good to have. We bought the insurance on December 31st. We bought this insurance on December 31st to cover the next 7 months of the new year. So at the time we bought it, it's an asset. It's only when we go through a month and we're covered with the insurance that becomes an expense. So what happened here? We bought insurance for cash. Our cash, of course, is going to go down, and we have another asset called prepaid insurance. Prepaid insurance went up, cash went down. And notice now we're starting to add some of those accounts you see at the back of your book, huh? We have 1, 2, 3, 5 assets going here. And we have 1, 2, 3, 4 components, if you will, of owner's equity. Mitch had to pay the delivery people. He had to pay the people delivering the pizzas. What happened? It was payday is what happened. So what's going to happen with cash? It goes down, and wages are an expense. That went up. So cash decreases by $1,650. Wages go up by the same amount. So over here on the red section, $1,650 additional expenses paid in cash. We're still in balance, but notice how the total equity of the business went down by $1,650. Deliveries made for cash on account. Okay, here's the reciprocal of one we had earlier. Here, he's delivering some goods. He's delivering pizzas all over campus, and some people paid him in cash, and others are going to pay him later, okay? So what happened? We delivered pizza pie, and we're going to get paid later for most of it. Some of it we get paid now. So we have another 3 account entry. What happened? Cash is going to go up by 900. Accounts receivable is going to go up by 2,600. And the total sale was 3,500. Here we look at the green, the olive colored section there. There we go. We had a nice sale. That's a lovely sale. $3,500. 900 of it was paid up front. 2,600 accounts receivable to be paid later. Accounts receivable, that's the amount of money your customers owe you at that point in time. So at this point in time, we have $3,100 in accounts receivable. That means you're my customer base. That means Christy owes me some money. Ryan, you owe me. Bernie. It all adds up to $3,100. Okay. Now here's a famous withdrawal as we get toward the end of this section. Here, Mitch came out and he took $3,000 out of the business for his personal expenses. Well, Mitch is the owner. He can do what he wants. He's probably not going to pay himself a salary. He's just going to withdraw money when he feels like it. So what happened? Mitch took $3,000 out of the business. Remember, we had a separate account now called withdrawals, drawing or withdrawals. That's going to go up and cash goes down. Cash goes down. Let's take a peek here. Cash went down 3,000. Withdrawals by the owner are reported in the drawing account, which is what you see here. And it's the opposite of an investment. When you invest money in your business, the net worth of the business went up. When you take money away, it's the opposite. The value of the business has gone down. Just like expenses, drawing will increase in this situation, but it actually reduces the owner's equity. And I call your attention to over here. Assets equal liabilities plus equity. Your equity is defined as plus capital minus withdrawing plus revenue minus expenses. So when this 3,000 came in, it actually reduces capital because you're subtracting that. Prepare and describe the purposes of a simple income statement, statement of equity, and balance sheet. Oh, let's take a peek. Three financial statements that all businesses put out. They put out tons of statements and sub-statements and reports and analyses, but right at the top of their 10K, early in the 10K, early in their annual reports are the financial results, income statement, statement of owner's equity, balance sheet. And you put a proper heading on it. You put the name of the company, income statement for the month ended. We'll talk about that. Oh my goodness, look at all this. I am not going to worry about this. I'm not going to talk about using double lines or single lines or dollar signs. You just put the numbers down as you see fit. Okay, we're not going to worry about that kind of thing. Look at the income statement. Look at the income statement. Make it a little bit bigger. Hey, the revenues were $8,000, huh? What expenses did they have? Well, looks like they had three. The $1,650 for wages, $1,000 in rent, $100 in phone. Total expenses were $2,750. Net income is $5,250. My question to you is, where did we get those numbers? Where did we get those numbers? We got them right from here. There's our 8,000 in revenue. There is the 2,750 in expenses. That's what an income statement is. In its simplest, purest form, like you see here, the income statement is sales minus expenses. Sales minus expenses. The sales were 8,000 and they had these three expenses. So this business earned a profit of 5,250. And that's a pretty darn good profit, I would say. That's almost 70% for Pete's sake. If you go to a bank today, they're not going to give you 70%. You'll be lucky to get 1%, okay? So he made a good decision starting this business. The statement of owner's equity, this one kind of scares students a little bit, and it really shouldn't. And I'll take you through it to begin with here. And you do this homework and it'll become second nature to you, I hope. The statement of owner's equity is simply this. It's your beginning equity plus your income minus your withdrawals, minus your drawings, equals the ending. You know the expression, bide your time? I got to bide my time, B-I-D-E. Beginning plus income less drawings equals ending. So let's see what we have here. Let's see, Mitchell Capital, there was no business until he put $5,000 into the business. So we can think of that 5,000 as the beginning. Net income was 5,250. We're going to add that, and we're going to subtract the 3,000. So they're just taking those two numbers and subtracting them out to show you the change. So the equity at the end of the month is 7,250. He grew this business from 5,000 to 7,250. So he got a 70% return on sales, which is pretty spectacular, I think. Plus, his business has grown by almost 50%. Okay? Please understand something I did not tell you. You must do these statements in this order. You cannot possibly do them in any other order than this. You must do the income statement first because we need the net income to carry forward to the statement of equity. And that's what we've done here. Then we do the statement of equity second because we have to take this 7,250 and bring it down to the balance sheet. The balance sheet. Now, what's the balance sheet? The balance sheet is a representation of the accounting equation. Balance sheet. Assets are totaled up. Liabilities and equity are totaled up, and they should equal. Assets equal liabilities plus equity. So let's look at some of these numbers. I see cash 470 and accounts receivable 3,100. They should have come from our work we did earlier. I think they screwed up a few of these numbers. I just want to see something. Now, here we go. Take a look. Your cash at the end of the period was 470. Accounts receivable 3,100, 80, etc. Your total assets were $9,150. We come down here. Here we go. There's your 9,150. Accounts payable, they brought that over, and then they just brought over the ending equity balance. So the key thing to understand there is the income statement is done first. The income statement in its simplest, purest form is simply sales minus expenses equals your net income or net loss. The equity statement, you take the beginning, add the income, subtract the drawings to get the ending. Bide your time, B-I-D-E, if you like acronyms. And finally, the balance sheet, all you do is copy every number from your general ledger. Copy every number from that spreadsheet we were working on, except the new capital number gets substituted in, and now we're back. And I'm going to show you this slide for one reason only. I don't think this is cheating. You ever hear the expression teach toward the test? I noticed they put this on the test the last couple of times. The accounting process, input, process, output, input, process, output. Business transactions are the input. Processing is using your brain power and then getting it out into the system. So that is a pretty good look, I think, at chapter 2. Does anybody have any question? What do you think, Christy? You're okay so far?
Yeah, the book actually helps to show the breakdown a little bit better than the slides. But
okay,
if you have your book, you can look at page 31, and that shows the overall entries, which is really helpful to see.
excellent, excellent. Good point out. How we doing, Ryan? You okay? Oh, Ryan may have.
Yeah, I'm okay. I'm okay. I've gotten most of what you've said right now.
Okay, so you're okay, you said?
Yeah, I'm okay. I'm okay.
Okay, sounds good. Bernie, I know you're good. You're always good. Who's W? Wendy, you how, any comments, Wendy?
No.
You followed it okay, you think?
Yeah.
All right. Kelsey, how are you?
I'm good.
What are two or three questions you have? No questions.
No, I think I'm good. I think it was pretty straightforward.
Okay, yeah, it should be at this point. And hi, Aranza, how you doing? Just want to say hi to everybody. How we doing, Aranza?
Doing good. How are you?
Okay, no questions?
No, pretty straightforward as well.
Okay, I guess we'll call the meeting to an end then, okay?
I just have one question.
Yeah,
You say that most of the questions which are coming for on the next quiz are going to come from what you've taught today.
okay, I'm just having a little bit of trouble hearing. Can you say that again, please, a little slower?
I'm saying most of the questions which are coming on the next quiz, you say they're coming from what you've taught today.
I'm so sorry. I'm just having, could you do me a favor? Could you chat your question over to me? I just have trouble hearing once in a while. It's not you.
I'm asking.
Okay.
I'm asking. Is most of the questions which are coming on the next quiz going to come from what you've taught today?
Oh, okay. Okay. With the source of the questions, the best predictor on the test is the homework quiz type questions. If you work on the quiz questions, which you have to do, and they're also set up so that you should get 100% on them because you have unlimited time. Those are almost exactly what the questions are going to look like on the test. So that's one good place to be looking. And also in the Cengage, the key terms at the end of the chapter are very worth studying and understanding. Does that help you?
Yeah, that helps me a lot.
Okay. Okay. Sounds good. All right. So I guess we'll call it a meeting then, huh? Everybody in agreement?
Yep, thank you.
Yep.
Okay. Bye-bye, everybody.
Bye.
Bye.
Bye-bye.